Or- So today we'll cover chapter 8, equity valuation. So this is quite technical, part. So probably it will take a little bit longer, but we'll do our best to finish that in time. All right. The Giovanni, can you read this, the first part?
Yes.
Right.
Two approaches to selecting, analyzing, and a value of a stock, depending on the perceived importance of economic and industry influence of individual firms and stocks. Number one, top-down three-step approach. Number two, bottom-up stock valuation, stock picking approach. Both approaches can be implemented by either fundamentalists or technicians.
Okay, thank you. So depending on the approach, there are two different approaches there. The first one is top down, like macro to micro, three-step approach. Second one is the bottom up approach. Usually, uh, like a better or best approach is like this top-down three-step approach that is considered a better and superior approach, right? So this top-down approach, they start with the macroeconomy and the security markets and down to industries and then down to company analysis. As you see that the graph there, right? So, Brian,
Yes.
yeah, can you read that the statement there, the sentence there? The first
Yeah.
yeah, can you go over that one?
Analysis of alternative economics and security markets. Objective: decide how to allocate investments funds among countries and within countries to bonds, stocks, and cash.
Yeah, that's right. As I said, this top-down approach, three-step approach, they start with macroeconomy and then security market. Not just macroeconomy, it's like international economy, international markets these days. So macro down to micro. So as I said, that's like, superior approach and like, several studies that support that approach. Okay. And then Andrew Morton.
Yep.
Yeah, can you go over this industry, the second part?
Analysis of alternate industries. Objective: based upon the economic and market analysis, determine which industries will prosper and which industries will suffer on a global basis and within countries.
All right, thank you. So starting with the macroeconomics, and the security market, you narrow down to the attractive industries. Like, you identify attractive industries and like, bad industries, identify those. And Andrew Wolf,
Yeah.
yeah, third one, can you do that? Did you just do that?
Huh?
You didn't do that, right? Go ahead, go ahead.
Where am I reading?
The third one.
The objective: following the analysis of the industries, determine which companies within these industries will prosper and which stocks are undervalued.
All right, thank you. So we talk about the economy and the market analysis, and then industry analysis, and then company stock analysis. So I think more details, we'll cover this more details in later chapters. So we talk about like three-step top-down approach, and after all this one, when you come down to company analysis, we'll do like stock analysis, equity analysis, and part of the equity, the company analysis, it will be equity valuation techniques, right? So there are two categories of equity valuation. One is discounted cash flow analysis. Second one is relative valuation techniques. Okay, so we'll cover all this one today. So discounted cash flow analysis. So depending on the cash flow type, we will cover the three different approaches. One is the cash flow is the dividend. Second one is free cash flow to equity, and then third one is free cash flow to firm. All right. Okay. So the dividend and cash flow to equity, it is about the company's equity, and free cash flow to the firm is the corporate overall like cash flows, right? And then our relative valuation, we will use P ratio, PS, the price sales ratio, and price to book ratio, book equity ratio. All right, let's move to the first one, cash flow, discounted cash flow approach. As I said, depending on your cash flow, we have this dividend discount model and free cash flow to equity model, and then free cash flow to the firm model, right? So you look at this one here, free cash flow to equity and DDM. Those two are related to the company's equity shareholders. So cash flow is the free cash flow to equity dividend, and this one is free cash flow to the firm, entire firm. Orders of the cash flows, as I said, the first one, the free cash flow to equity DDM is about like shareholders, but the free cash flow to the firm, all the capital providers, including shareholders, bondholders, and preferred stockholders. So because of this difference, the discount rate that we use is different. The first two is the cost of equity. We use that, but the third one, free cash flow to firm, we use weighted average cost of capital, which is the cost of capital for the entire corporation. And once you calculate the whole thing here, the last outcome will be value of equity. This is value of equity, right? This one is value of entire firm, and then we have to adjust for the death obligation and preferred stock obligation, and then we can calculate value of equity. So there's some additional step that we have to do, right? We'll do that. So basically, the principle of the evaluation, security valuation, is nothing but the intrinsic value, theoretical value, is sum of all discounted cash flow, discounted value of future cash flows, right? So future cash flow, that is discounted, and then sum them up. Okay, that is the principle of the valuation. So the first one is this dividend discount model. So as I said, the intrinsic value, theoretical value of that equity is the sum of all discounted value of future expected dividend. So I said future expected dividend. That means D1 is expected dividend at the end of this year. D2 expected dividend at the end of next year, and so on and so forth. Okay, so we are driving like security valuation based on the company's future expected cash flows, and then discount them and then sum them up. So that's why we say the stock price or security price is forward-looking. So it is the model itself is based on the forward expected cash flows, right? All right. One typical approach is, if you look at the dividend payment, usually dividend grow over time. So, I mean, some like big established companies, their dividend, usually dividend grow over time. So, and their growing pattern is more stable. But some companies that does not show that stable pattern is, it depends on the company's financial condition and the earnings. So sometimes dividend can go up and down, slightly down, up and down. There might be some variation, some fluctuation. However, if you look at the long range, long horizon, it is on usually dividend grows over time. Okay, so suppose if we estimate that growth rate over time, suppose we estimate that growth rate, then assuming the growth rate is stable growth rate, then the whole valuation model comes down to this model. V is equal to D1 is the expected dividend at the end of this year divided by K minus G. K is cost of equity, the discount rate minus growth rate. So this stable growth, stably growing dividend or cash flow, the widely used the valuation model is V is equal to D1 over K minus G. So we have D1, K, G. There are three factors, three input in dividend discount model. Let's talk about these three factors. The first one is growth rate. So growth rate, there are different versions of growth rate. One popular, one widely used approach will be the financial statement based, the growth rate, estimating growth rate based on financial statement. So growth rate is equal to return on equity times retention ratio, right? The retention ratio is 1 minus payout ratio. It's the same thing. Okay, so growth rate is the return on equity times the retention ratio, or growth rate, return on equity times 1 minus payout ratio. That is called sustainable growth. As I said, this is not the only growth rate. Okay, sometimes if you look at this one, sustainable growth rate is too high. We cannot use that one sometimes, right? But let's assume this one. Later on, I'll show you how to estimate some other alternative growth rate. All right, payout ratio, for example, payout ratio is 57%, and return on equity is 16.3%. As I said, this sustainable growth based on the financial statement is return on equity times retention ratio. So you can calculate this way. Return on equity is 16.3% times payout ratio is 57. So 1 minus payout ratio 57%. So this is how you calculate. This is how you calculate your growth rate, sustainable growth. So we get, let me calculate this one, right? We got 7.01% growth rate, 7.01% growth rate. So we calculate growth rate, right? if you calculate, so for some companies, if you calculate this growth rate, it could be like 15%, sometimes 11%, 10%, 15%, or 20-some%. If the growth rate is that high, we cannot use this growth rate. We have to calculate. I mean, we have to look at the actual data of dividend or like earnings or like asset, actual like change of those variables, and we estimate, we calculate, manually calculate growth rate based on the data, right? Not this like this formula, right? So, but right now, let's assume that this one is our approach. So we have 7.01%, that's decent growth rate, right? Good growth rate. Now, next factor input is K. That's the discount rate or cost of equity. Now, cost of equity, how do you estimate this one? Do you remember that the capital asset pricing model? Capital asset pricing model. That's a theoretical required rate of return. So to calculate discount rate or cost of equity to be used in the security valuation, stock valuation, we use the CAPM model, capital asset pricing model. So given risk-free rate of return, the T-bills return of 4%, beta 1.2%, and market return is 10%. We can calculate CAPM return like this. Risk-free rate of return is 4% plus beta 1.2% or 1.2 times market return is 10% minus risk-free rate of return is 4%, right? That's how you calculate. I mean, do you remember that, CAPM return, right? This is the CAPM return. And if I put, equal sign, that's 11.2%. That is, these stocks, these companies, the required rate of return. Okay, CAPM required rate of return. Now, so we calculated two factors. The remaining factor is D1, right? So given the most recently paid dividend last year, if the dividend, last year's dividend was $2, if the company, this stock paid $2 dividend, meaning the entire year, like last year, $2, then, so, here, last year, look at this one here, 0, this year, that was $2. Then D1 is at the end of this year, this one, at the end of this year is, based on this $2, not $2, but it is expected to grow at the 7%. So how do you calculate that? $2 times 1 plus 7.01%, right? So let me just use this one here. 7.01%, that's a gross rate, right? Gross rate. That is like $2, 14, like $2.14, right? $2.14. That is the yeah, $2.14. It is, that's $2.14. Or, let me just use 7.01%. 7.01%. That gives you 2.14. 2.14. And what about this? The 33. Yeah, it's the same thing, but this way. All right. Now, then the next year's like dividend is again, it should be grow at the 7.01%. So this one times 1 plus 7.01%. That's it, right? All right, this one also is all right. So 2.2 $2.29, and the next tier is just a moment. Let me calculate this one here. It is this one previous years times 1 plus 7.01%. That is $2.45. So this is the dividend cash flow, expected dividend at the end of this year, next year, and the following year, and so on and so forth. So we successfully calculated D1 here. You know, D1 at the end of this year is quite like predictable. So, and it is not that difficult to get the estimated dividend at the end of this year, because they usually announced it in beforehand. So $2.14, we calculate this one here. So we estimated growth rate, the cost of equity, and dividend. Let's use that. So D1 is $2.14, $2.14 divided by K is this one here, 11.20% minus growth rate here. That way, if you calculate this way, you get $51, $6. Okay, $51.06. That is the intrinsic value. It is called intrinsic value, theoretical value of, you could say, fundamental value. Theoretical value or fundamental value. Okay, this is the value that you can use to compare that to the current market price, right? It's called intrinsic value. All right. If you look at the this intrinsic value, $51.06, this one has like two component. One is this intrinsic value. One is this portion of intrinsic value due to growth opportunity. The other one is no growth value, is like, asset in place. The value comes from asset in place. So we will like take micro look at this structure for our problems there. All right, now, Kennedy, can you read this one?
What?
Yeah.
Yeah.
The PVGO equals intrinsic value V number growth value. So one, for an analyst, very important to understand how much of stock value comes from asset in place and how much comes from future growth. Two, maybe thought of as a risk factor, higher PVGO interpreted as a higher risk factor.
Right, thank you. So if intrinsic value include the asset in place, no growth asset, established asset value, and plus one is like intrinsic value coming from future growth opportunity, then this no growth value that is already like secured kind of, but this one comes from future growth opportunity. So it is about the future opportunity. So you could say this present value of growth opportunity, it could be thought of as a risk factor. There is this uncertainty. So if the PG present value of growth opportunity is high, then you could say that that stock, that company is riskier compared to others. All right. So now we have $51.06 here, right? And then present value, to calculate this two component, you start with the no growth value. No growth value. Again, no growth value is that's the value, the stock value comes from asset in place. Okay, asset in place. And so let's calculate that one here. So what you do is no gross value means growth rate is 0. So in the above model, just enter 0 for growth rate. So what you do is 2.14, that's a D1 divided by the K minus 0, so K is 11.2%, right? 11.2%, right? That's the no gross value, right? No gross value, if you look at this one here, and the remaining is like the PVGO, the 51 minus 19, that's PVGO. So if you change this two component, like intrinsic value two component, into percentage there, look at this. No gross value is 37.4%, but PVGO gross opportunity is like about 63% there. It's pretty high, right? So we could say this stock is like relatively risky stocks, right? Risky stocks. So you could say that way. I mean, that's how you interpret this result. Okay. Right. Now we just so the simple typical model, normal typical model. Now this case, this one here, this case is a combination of like our simple model there, it is included here. But the first 3 years, the growth rate is 10%. It's like quite high, unusually high, right? So year 1, year 2, year 3, that the growth rate is 10% is high. But after that, after year 3, that is stabilized at 4%, forever. I mean, for the permanently. Okay. So this portion is the portion that we discussed above here, right? 7%. So let's do that. So when you have this combination of this unusual portion and the usual normal typical portion, then you have to solve this one separately. First, you take care of this in the normal cash flow, normal pattern. Okay? What you do is, for example, the question is, expected dividend at the end of this year is $1. $1 is here. And then this dividend will grow 10% per year for 2 more years. After that, the dividend will grow 4% per year, right? Like after this one. And then the cost of equity is 14%. All right. Here. We have abnormal, portion, right? Abnormal portion. And we have normal portion. Yeah. Now we take care of this normal portion first. How do you do that? If you have normal portion like this, what you do is you calculate V at this point. Beginning point, V is equal to this one. D1 is this one, K minus G divided by K minus G. You do calculate this way here. So let's apply exactly same formula, same approach, and calculate that in here. So this is what I'm going to do here. Oh, by the way, since the first 3 years 10%, after that 4%. So the first year, this one is not given yet, right? This not is given yet. How do you calculate the all dividend cash flow? Now, the one thing we know is $1 is expected at the end of this year, and the next year is, right? Look at this. This one times, 10% high growth rate. 1 plus 10% growth rate. That is our expectation there, the following year. And the same for the following year, times 1 plus 10%. that is what we expect, and dividend that we expect. See, dividend is growing like abnormally high, right? Abnormally high. And after that, it will be stabilized at 4% annual growth. So how do you calculate that? Starting with the previous one times 1 plus now 4%, right? 1 plus 4%. That is 1.2584. That is the dividend that is expected at the end of year 4. And then at the end of year 5, this one times, starting with the previous dividend, 1 plus, and then 4%. 4%. See, that's how you calculate. Let me put it a little bit this way. All right. So that is the dividend cash flow, So we calculate all these dividend cash flows, expected dividend cash flows for the future. Now, using this method, we calculate the value at the beginning of this normal portion. Beginning of the normal portion is here, 1.26, that's like D1, divided by K is 14%. 14% minus growth rate is 4%. 4% here. So that is 12.558. It is that one covers all the cash flows this way. All the future cash flows after 3 years, that is reflected, summarized in this one. And it is called terminal value. All right? Terminal value at the end of year 3, or the beginning of year 4. That is called terminal value. So the whole thing, all cash flows are summarized in here, captured here. So after doing that step 1, well, stage 1, we took care of stage 1. Now we come down to 1, 2, 3, 4 cash flows, right? 1, 2, 3, 4 cash flows. So we just have to take care of these 4 cash flows. Now, as I said, the value is sum of all discounted cash flow, or the discounted value of future cash flows. So let's calculate the present value. Present value is this one divided by 1 plus, the cost of equity is 14% to the 1, right? To the 1, this one, you can say that one. And the next one is present value is this one divided by 1 plus 14% to the, is over 2-year period, right? To the 2. Okay. And this one is, now this one is like, we have 2 cash flows. So we have sum of this 2 divided by 1 plus 14% to the, now 3, right? You could enter 3 or this. All right. So we successfully calculated present value of all cash flows, relevant cash flows. Intrinsic value is nothing but sum of all these cash flows, all this present value. Yeah, $11.03. That is the intrinsic value of this stock. All right. Now, as I said, this intrinsic value, theoretical value include your 2 components. One is present value of growth opportunity. The other one is no growth value. Let's start with no growth value, right? So it's the D1 is this one, right? D1 1 over like 14%, 14% minus 0. That is 7.14, right? 7.14 as we did above. Now, then Present value of gross opportunity is this minus the rest. This is minus this one. It is $3.89, right? So let's change this component, two component of intrinsic value into percentage. So this one divided by intrinsic value is 35%. Okay, not bad. Divided by this one here, 64%, okay, 65%. So in this case, no gross value is like 65%, and present value of gross opportunity future is like 35%. So it's compared to this one, it's the opposite, right? So asset, like established asset, the value from our already established asset is like 65%, and future growth opportunity we have 35%. Is quite like stable stock. This one is the opposite, right? Present value of growth opportunity is like 63% there. So it's quite like volatile or uncertain, or the risky stocks compared to this one here. All right. We applied exactly same approach to this one here. This one is like case study in our textbook. So let's do it. So Cisco is a real company, right? Cisco in 2000, 53 cent dividend, right? They paid 56 dividend in 2000, right? Yeah. So already paid dividend is 0.53. That is not relevant because we are looking at the future expected cash flow. So using this one, we will calculate expect dividend next year and the following year, right? So let's do that. I mean, here, get this here, 53%, and then you thought this one grow their dividend per share at 20% per year for 5 years. Look at this one. The first 5 years is abnormally high growth, right? So the company will pay like abnormally high growing dividend for the first 5 years. And after that, it will be stabilized at 5%. So after that, the dividend will grow at annual rate of 5%. So this one is normal. This one is abnormal. Okay. So based on this one, how do you calculate that? I mean, again, I mean here, this moment, this one is not given, right? This one is not given. This one is not given. We just calculate. How do you do that? So the first 5 years is 20%. That means you calculate this one based on the 53 cents times 1 plus 20%. Right? This is how we calculate. This is the mathematical definition of gross rate, right? So dividend will go to 64 cents, and the same thing, starting with the 64 cents times 1 plus 20%. That is the following year. All right. Because this one will repeat like for the 5 years, like let's just make copy and paste for the first 5 years. So in year 5, it will end up with $1.32. After that, it will be stabilized at 5%. So after that, you start with the $1.32 times. This time, it will grow at 5%. See, 5%. That's it. And then the same thing for the next year. So copy and paste. So this is the dividend cash flow pattern. Dividend cash flow. The first 5 years, it will grow at like a high rate of 20%. After that, it's a stable rate of 5%. That is the Cisco systems like prediction estimation. right? So terminal value, as I said, if you have this combination of the abnormal pattern and normal pattern there, then you have to tackle this normal pattern first, calculating terminal value at here, this timing, either at the end of year 5 or beginning of year 6. Let's calculate terminal value. It is D1 divided by its cost of equity is 12% minus the growth rate is here 5%, 5% there. You see that? That's the terminal value that covers all cash flow here, right? All expected future cash flow after year 5 is captured in here, right? So there. So we came down to 1, 2, 3, 4, 5, 6 cash flows. 6 cash flows, and we take care of exactly same way we did above. Yeah. Let's calculate their present value. Even though this one, there's nothing here, let's do this way. Sum of this two. All right, that covers everything up to here, right? So divided by it's a 12%, 1 plus 12% to the 1, there to the 1. So that's the present value for the first one. Second one is same way. Sum of this 2 divided by 1 plus cost of equity 12%. This time to the second. It's over 2-year period. Once you do that, you just copy and paste, right? Copy and paste there. That's it. You see that? We can do that. We can do that. All right. All right. Did we do that right? 12%. And this one 12%, 12%. Yeah. See. All right. Now, intrinsic value this time is sum of all this cash flows, all this present value. Sum of all this present value. Oops, what did I do? Oh, yeah. Sum. And you should go. Sum them up. $14.50 is our, the intrinsic value, theoretical value, as I said, right? Intrinsic, theoretical, this stock value. All right. Let's assume that the no gross value, let's calculate that. It is starting with this one here, right? 0.64 divided by just K, 12%. K minus 0 is like $5.30. And this one is the rest of this one, this minus this one here. So change that one to percentage. This one divided by this one here is a 63%. Let me change that to 3%. And then this one is now this one divided by this one here and change that to percentage. Look at this. See, that's the exactly opposite to our previous stock, right? So the Cisco stock, the intrinsic value is $14.50, but 63%, 63.4% of the value comes from the future growth opportunity. Like established asset, right? Asset in place, the value coming from established asset or asset in place, that is about 37%. So this one looks, quite risky, volatile, or riskier stocks compared to this one here. This is the opposite, right? So this is how to calculate and how to interpret the result. Right? Interesting, right? All right, yeah, let's move to the next one. This one, free cash flow to equity. And free cash flow to equity is the free cash flow that is available to stockholders after payment to all, like, capital suppliers, debt, debt holders and purpose stockholders after providing for the continued growth of the firm. So it's a net income plus all this cash flow. I mean, all this one plus, new debt issues. So this one is the formula, but in fact, I'll show you how to calculate that, those hint in here. So free cash flow to equity, we estimate all this one, and then calculate the present value and sum them up. That is the value of this stock or this equity. Stock's equity is the same thing. I told you valuation principle is sum of discounted value of all future expected cash flows. Okay. Now, assuming stable growth rate, G, stable growth, then this model comes down to this way. We is the first one, D1, which is comparable to D1 over K minus G, right? K minus G. Yeah, 3 input. Let's talk about this one here. This example is like abstract version of abstract illustration of how do you calculate like free cash flow to equity, right? I think you will find it why that is the case. Now, growth rate, again, let's use the sustainable growth. So return on equity, the given information here, right? Given information. So the company has like 300 million assets, include the 100 million debt and 200 million equity. A return on equity is 10%, retention ratio 60%, cost of equity 15%. So let's calculate growth rate first. Return on equity is 10%. 10% times, what is the retention ratio? Retention ratio is 60%, right? Just by 60% retention ratio, yeah. So 6% is our growth rate, right? Now, it gives you cost of equity. Suppose cost of equity is given as the 15%. I told you cost of equity, you calculate cost of equity, derive cost of equity using CAPM model, right? Capital asset pricing model. That's how you do that. So as a result, we got, let's assume we got 15%. Now, forget this one. Like, pay attention to this one here. Okay. Now, let's calculate. We are given like 300 million, 100 million, and 200 million for this balance sheet. So 300 million assets include debt financing 100 million, equity financing 200 million, right? And the growth rate is 6%. So all this on asset grow at 6%. So this 300 is 300 times 1 plus 300 times 1 plus 6%. There's a 318. That is 100 times. Okay, 100 times 1 plus 6. 6%. That's 106, right? And then that one is also 200 times 1 plus 6% gives you like $212 million. Okay, so if you sum them up, it's $318 million, which is identical to, well, that's it. It should be. Now we have to use this one here. Return on equity is, as you see, net income divided by equity, total equity. Net income divided by total equity. That means net income is equal to return on equity times equity, like this. Net income is equal to return on equity times equity. So how do you do that? Net return on equity is return on equity is I mean, yeah, is 10%, 10% times total equity is starting value is this one, $200. It is $20 million. That is a net income, the company's net income this year. And then it says retention ratio is 60%. That means 60% of this net income will be retained and in like retained earnings to support to finance the company's like expansion and growth. So let's calculate this one. 20 million, 60% of 20 million. So 60% of this 20 million will be kept inside the company. So it's a retained earnings. The rest will be the remaining thing after this calculating is $8 million, $8 million, 40%, right? That is called free cash flow to equity. All right, free cash flow to equity. It is the amount, it is the capital, free cash flow, that is available to shareholders, right? Shareholders. So free cash flow to one is $8 million. So let's calculate this one here. Free cash flow to equity is $8 million. One is $8 million divided by K minus G. K is 15%. 15% minus growth rate is 6%. 6%. And if you calculate that is $88.89 million. $88.89 million. It is the total value of equity. Total value of equity. Total equity. $88.8 million. Total the stock, total equity, right? So if you have 1 million shares and stock price will be 88.89 million divided by 1 million is $88.89. That's the per share stock price. Per share stock price, right? All right, this is the simple example. Now this is the case study of the Cisco in our textbook. Okay, in our textbook, it shows in where is it? In two-stage model here. So it is because look at this first. At the end of year 16, like we are. This 0 is 2016. 0 is 2016. Now this is 2017, 2018, and this one here, right? So since it is the past one, but they are trying to get the value, intrinsic value, as of beginning of 2017. Right, 2017. So instead of using 2016, 17, I used 0, 1, 2, 3. Okay, that would be easier to understand. Okay, so 2016, their per share sales value is $9.78 here. $9.78. Now it says, and then after that, sales are expected to grow by approximately 4% per year for the next 5 years. And after that, forecast slightly lower rate 3.75% into perpetuity. You see that? The first 5 years is a little bit higher sales growth, but after that, our projection is it will be settled or stabilized at 3.75% permanently. See, we have this normal pattern. This is the abnormal pattern. Is higher growth rate. This is the normal pattern. So it's a combination of two stages. All right. Now, given this information, profit margin is 24%, okay. Return on equity is 20%, and then cost of equity is 9.5%. Given this information, what we need to do is we have to drive free cash flow to equity. Free cash flow to equity using all this information. Now, we start with the sales projection first. This per share sales projection, it's a 4% growth. So it is this times 1 plus 4%. That is the sales projection at the end of this year. Okay. Since this one is like all 4%, you could just copy and paste. That is our sales projection for the 5 years. After that, it will be stabilized at 3.75%. So let's do this one. Previous one times 1 plus 3.75% increase. Okay, that one. And the same thing for the next year. So let's just copy and paste. This is the all the projected sales for the next in the future, right? In the future. So we calculate this one first. This one. So we successfully calculate sales projection. Now, the next information is given is profit margin is 24%. Profit margin is 24%. So that means profit margin is earnings per share divided by sales. I think you know that from Fin343. Profit margin is earnings per share. Wait a second, this one is earnings per share, not SP, per share. Right, earnings per share divided by sales, right? That means earnings per share. Earnings per share is profit margin times sales. Sales, move this one there, right? Or earnings per share is 24% times sales. Okay, so that is how you calculate here. Profit margin times sales is this one. That is earnings per share, net income. Okay, net income, that is $2.44. And then that's the same thing for every year. So just copy and paste. That is the earnings, future net income. Now, as you see, there's a free cash flow to equity is earnings, net income times payout ratio. Payout ratio is 40%. Retention ratio is retained earnings. Payout ratio is 40%. Is if you multiply that one and this one, then you calculate the free cash flow to earnings. Here, one information here, where is that? Return on equity there. Growth rate is here. We have to calculate return on equity and payout ratio because it is not given there. It is not given. We have to use this formula, right? Growth rate is return on equity times retention ratio. Return on equity times retention. So retention ratio is equal to growth rate divided by return on equity. Growth rate divided by return on equity. All right. Okay. You get it? We have to use this formula. So how do you calculate the retention ratio? Is growth rate is 4%. 4% divided by, what is the return on equity? Return on equity is here, 20%, right? So 20% there. That is the retention ratio. And then it's the same thing for all those. Let's copy here. Get this. First 5 years is retention ratio is 20%. And after that is 18.8% after that, right? So there's a retention ratio. And payout ratio is nothing but 1 minus retention ratio, right? 8%, 80% is 80%, 81.3%. That's the payout ratio. That's what we need. All right. Now we're almost there. The free cash flow to equity is nothing but net income, earnings per share times payout ratio. That's it. This one times payout ratio. It is our free cash flow to equity. So it's copy and paste. Copy and paste. Are you following me? Am I going too fast? Are you okay?
Yeah.
Okay, good. You know, if you look at the textbook, it's quite it's not very friendly. I mean, you could easily lost in this in the process. So what I did here, I made the whole thing simple and more understandable, more so that you can follow easily there. And then I put this relevant information and equation for your information there. So I think it will be, if you follow this one and repeat this one, and if you follow this one and understand this one, is easy. The rest will be easier. Okay. So don't waste too much time and effort, like, on textbook. This one is an easier version of textbook. Okay. All right. Now, since we have this normal component and abnormal component here, so we have to do the same thing. Terminal value. Let's calculate terminal value. It is this one, right? Divided by K minus G. K is 9.5%, 9.50%, minus growth rate is this one growth rate is 3.75%, right? 3.75%. It is 3.75%. That's the growth rate. That's how you calculate terminal value on this case. Terminal value, all right? Terminal value. So what we have is, we have all the cash flows. We have, just a moment, yeah. Yeah. We have all the cash flows that we need, right? All the cash flows that we need. And we just work on this one here. Let's calculate present value of each cash flows, right? This one is this one divided by, since we have two cash flows, let's do this way. Sum of this two divided by 1 plus our cost of equity, 9.5% to the 1, right? Over 1 year period. Yeah. And second one is the same way. Sum of, this 2 divided by 1 plus 9.5%, that's cost of equity, to the second year. It is year 2, so over 2 year period. So to the second power. All right. And since we covered everything, just you can now copy and paste there. Okay. So that is all present value of all these cash flows. And then intrinsic value of this stock, this equity is sum them up. That's it. $34.66, right? They are, okay, they are, this one is the intrinsic value of that stock, all right? So the intrinsic value, $34.66. Now, as I said, we know that there's a two component there. So let's calculate the no gross value. It is like starting with this one, 1.73. So 1.73 divided by our cost of equity, 9.5%. 9.5%. It is 18 point, is that right? Yeah. 9.5%. Yeah. That is our no gross value. And this one is total thing minus this no gross value. It is this one here, right? So if you change this one to like, percentage. So let's see. This one divided by, this one gives you 54%. So percent, all right. This one divided by, this one is percentage, 45%. So this one is like 45.8% comes from the future growth opportunity, right? Future growth opportunity. So it is still, it is not that like, unusually high, but it is still like a half of the intrinsic value comes from the future uncertain growth opportunity. Still, like, volatile, right? Not so volatile as we discussed here. Is very volatile, but this one is not as volatile, but still in a volatile area. All right. Next one. Next one is called free cash flow to firm, right? So this one is free cash flow that is available to all capital providers. No, you calculate this one, free cash flow to the firm. There's a NOPAT minus net spending or net investment in net fixed asset minus net spending or the investment on operating working capital. So if you look at this two, net fixed asset, net operating capital is sum them up. If you sum this two, if you combine these two, is called net reinvestment or net investment, net reinvestment in our assets. Okay, you could say that. Free cash flow belongs to all providers of capital. The discount rate must incorporate all cost of capital. That means it should combine cost of equity, cost of debt, cost of preferred stock, if any. So you have to calculate weighted average of cost of capital. That should be the right, discount rate for this calculation. Okay. So weighted average cost of capital is now here. If you look at this one here, that is used as discount rate, and we calculate free cash flow to the firm. Okay, free cash flow to the firm. So sum of discounted value of all future free cash flow to the firm, it is the intrinsic value of this case. Given constant growth rate G, right? Given constant growth rate G, our the total value is in the total value. This total value is total value of our business operations. Total value of our business operations. So total total value of business operations, it is this one. I mean, free cash flow to the firm divided by WACC minus G, assuming constant stable growth rate. All right. Let's cover one simple question and then a big question there, right? So consider free cash flow to the firm, 0, that means last year, 24 million. So to calculate free cash flow to the firm this year, at the end of this year, is last year 24 times growth rate is here 5%, right? 1 plus 5%. That gives you $20.52 million is the free cash flow to the firm 1 at the end of this year. We calculate that. WACC is the 18%, and the growth rate is 5%. Marketable security 100 million. That is like 200 million. Purpose stock 50 million. Number of shares in 10 million. Now, given all this information, this is the typical step. This is typical step. Now, to calculate your total operation, the total value, market value of total operation is, how do you calculate using this one? Our first, free cash flow to 1 is 25.20. 25.20 divided by weighted average cost of capital 11%, 11% minus growth rate is 5%, 5% there. If you calculate that one, that is the total value of our operations there. Value of total operation, $420 million, right? And then we have short-term investment. That's our assets, right? Add that one and 520 million. And we have debt obligation there, right? Debt obligation 200 million, subtract, and preferred stock obligation 50. So we have remaining value is $270 million. It is total equity value. Value of total equity. So $270 million. Now we have 10 million shares here for our company. So if you divide this total equity divided by 10 million, $27, it is the common share, common stock value, intrinsic value, $27. Okay, $27. All right. All right. This one is our case study in our textbook. Let's follow this one, step by step. Okay. Cisco, the sales for the year that just ended. Again, I told you that just ended is 2016, right? Let's use that 0 last year. $48.9 billion. $48.9 billion here, right? $48.9 billion. And this sales is projected to grow at 4% for the first five years. And after that, it will grow, stabilized at 3.75%. We saw that last time, right? So we start with the this sales projection first. Let's calculate that one here. This one last year times 1 plus 4%, 4% there. There is our sales projection for this year, at the end of this year. And then for the 5 years, it's all 4%. So, copy and paste there. So these are sales projection for the first 5 years. And then after that, it will grow at 3.75%, 3.75% there. See? And then the same thing for the following years after that. So that is our sales projection. There's our sales projection there. Projection. All right. Once you calculate the sales, expected sales, then the next one is we have to calculate, come up with the free cash flows there. Now, here we are given all this information there. First, to calculate NOPAT, I told you there's a NOPAT, right? NOPAT, right? This NOPAT is this NOPAT. This EBIT minus taxes. EBIT minus taxes. All right, EBIT minus taxes. So we have to calculate EBIT. Tax rate is given here, 22%, right? 22%. Now, EBIT, related EBIT, we are given operating profit margin. That's, this is the one here. Is EBIT divided by sales. That is an operating profit margin there. You see that? Operating profit margin is EBIT divided by sales. That is 33%. Okay, 33%. You see it. Operating margin is 33%, is EBIT divided by sales. So to calculate EBIT, you just multiply 33% times sales. 33% sales. That is how you calculate EBIT. So let's do it. And times your sales projection is this one here. So that is your EBIT. Let's copy and paste for all years. That is your EBIT. Earnings before interest and taxes. You remember that? Earnings before interest and taxes. So EBIT divided by sales, that is the operating margin. That is by definition is the operating margin. Now taxes is 22%. So 22% of this EBIT times 22%, it is taxes. $3.672 billion. Right? And that is the taxes for each year, right? Each year. Now, NOPAT, as I said, NOPAT is EBIT minus taxes. So EBIT minus taxes there. $13.09 billion is NOPAT in the first year. Let's copy and paste. All right, copy and paste. All right, we came up with NOPAT, right? And then the next information is this one. Reinvestment rate as a percentage of NOPAT is first 5 years is 26.29%, and after that 24.65%. I told you NOPAT, and then reinvestment. That means reinvestment in net fixed asset or reinvestment in net operating working capital. That those two included. That is included in the reinvestment. Okay, so 26.29% of NOPAT will be reinvested to purchase net fixed asset and then operating asset there, operating capital. So 26.29% of NOPAT. That is the reinvestment, all right? The same thing for this one here, 26.29% times our NOPAT. That is your the reinvestment amount. And let's copy that. And up to 5 years, right? After that, is changing 24.65% times our NOPAT. It is the reinvestment. And the same thing for the next year. Copy and paste. Look at this. These are all reinvestment your investment amount for the year, for each year. Now, as I said, NOPAT is EBIT minus taxes. I mean, I know the free cash flow to the firm is NOPAT minus reinvestment. So NOPAT minus reinvestment, it is $9.649 billion is the free cash flow to the firm, one. And then two is, let's just, let's do copy and paste. Paste. So these are all free cash flow to one, free cash flow to the firm, 2, 3, 4, 5, that way. All right, that way. Now, again, as you see, we have higher abnormal pattern is included here. This is a two-stage model. So this is abnormal stage, and this is normal stage. So I told you the first step is to take care of normal stage by calculating terminal value. How do you do that? This one, free cash flow to this one divided by oh yeah, we have to calculate weighted average cost of capital here. I calculated the weighted average cost of capital. It's 8.65%. Let's calculate this one first, and then I'll show you how to calculate. All right, see that 8.65%. 8.65% minus gross rate is 3.75%, right? 3.75%. That is our terminal value. Terminal value. So to calculate this terminal value, look at this. Where is it? To calculate this terminal value, here you have to use weighted average cost of capital and gross rate. So let me write this one here. Now we use this one, and gross rate is this one. Let's calculate this one here. Look at this. It shows market value of equity is $150 billion. And then the market value of debt is $25 billion. So total is what? 175, right? $175 billion. $175 billion. Now, and there's no preferred stock. So, no preferred stock. It is there. Where is it? Yeah, it's not shown. Okay. To calculate weighted average cost of capital, weight 1 times cost of equity. Weight 2 times weight debt times cost of debt. So that's what we do. So this one is 175. 150 divided by 175 is the weight of this equity. So 150 divided by 175, it is 85.7%, right? And then this one is 175, it is like 14.3%, right? 14.3%. So cost of equity is given there, given. So what you do is weighted average cost of capital. You have to calculate that one here. So weight is this one here. I mean, now let me just get rid of this. So weighted average cost of capital is the weight of that capital times cost of that times 1 minus t. It is like a tax benefit. You have to make tax adjustment for tax. So it's a 4 point, it's pre-tax. 4.54% times a weight. We have to use weight first. Weight is like 14.3%. This one times, where's it? Weight? Oh, here. 14.3%. That's the weight times cost of death. Pre-tax cost of death is 4.54% times, tax rate, tax adjustment, 22%. plus weight of equity is 85.7%. This one times cost of equity is 9.5%. 9.5%. So we calculate that since we don't have any preferred stock. That is exactly 8.65% here. Yeah, 8.65%. That is how you calculate, how we calculate weighted average cost of capital. And then that is here. And then we use that one here. So again, terminal value is this one divided by 8.65%. 8.65% minus growth rate is 3.75%. If you do that, you calculate this much. 244.32 billion, $32 billion. Okay, that's a terminal value. So we have this cash flow now. We have this cash flow. We came down to this cash flow. Whole like cash flows, we like simplify this, down to 6 cash flows. And the next stage is calculate present value. This one, I mean, as we did the sum of this 2 divided by 1 plus our weighted average cost of capital is 6.85% and 8.65% to the 1, right? To the 1, that is this one here. Since we since we used all this formula, you can do copy and paste there. All right, copy and paste. This is the present value of all these cash flows. All right, if you sum them up, let's sum them up. That is the total, the equity value. So if you calculate that, them up. Oops. All right. $202.13 billion, $13 billion. That is our answer here. Okay. So our total equity value, I mean, this is called enterprise value or enterprise value, total, not equity, I mean, enterprise value. Our enterprise value, because this is the free cash flow to the firm. Now we have debt obligation at $25 billion, right? $25 billion debt obligation. And then here, and nothing else, right? So subtract this one here. This one is like the total enterprise value minus this debt obligation. It gives you equity value, total equity value, right? Now we have total number of shares of 5 billion shares for the Cisco. So this one, 5 billion. So you just divide total equity value divided by 5 billion. It is how much? 35.4, this one, $35.43. It is our stock value, common stock intrinsic value, common stock value, right? It's quite neat, right? Complicated, but if you follow the step, it's neat. So it is theoretical intrinsic value of the Cisco common stock, all right? Again, I mean, if you look at the textbook, that is quite complicated. Use all this structure. I made it like as easy as possible, as like friendly as possible. So use this one and repeat this until you understand the whole thing. Okay, we have one more page to go. All right, relative valuation. Okay, let me have water just a moment. So we complete all like discounted cash flow approach. So DDM, right? discounted dividend discount model, and free cash flow to equity model, and free cash flow to the firm model. And then that's one category, discounted, the whole thing is discounted cash flow model. And this one is relative valuation. Relative valuation, all right? So, so this one is you don't have to focus on the cash flows. You use this given formula, and the first step is you get the estimated expected value, expected earnings, and expected earnings. So expected sales we did. So based on those expectations, we calculate expected fundamental the relative ratios here. One is P ratio, price sales ratio, and price to book ratio. So we calculate these fundamental values, and then we compare that to the actual value. And then we make our conclusion. Okay? So let me make it simple. The first one is price earnings ratio. There are two different versions of price earnings ratio. One is trailing, one is forward, right? So usually forward is the more popular way, right? More popular way. So the formula is this one here, right? Especially the forward P ratio is payout ratio divided by K minus G. So if you look at this one here, the higher the payout ratio, P ratio, I'm sorry, P ratio, the higher P ratio, that means investors are willing to pay more for the company's earnings, for the company's unit earnings. So it's include investors' evaluation of the company, right? That one, if you look at this one, the P ratio it will be higher when growth rate is higher, right? And when cost of equity is lower, and when payout ratio is higher. So, if the growth is higher and the payout ratio is higher and cost of equity is lower, then you will get the higher P ratio. That's the relationship here, and based on this one. And price to book ratio. This one is this trailing is more popular. Investors will pay more for $1 of book value of equity, right, of the company's equity, if the company generate higher return on equity. Return on equity, the higher the return on equity, the higher the payout ratio, and the lower the cost of equity and higher growth rate, and then the higher book to market ratio. Price to book ratio. That's the relationship, as you see. Price sales ratio is this one here. So if the the company has higher profit margin, higher payout ratio, and lower cost of equity and higher growth rate, your forward price sales ratio is higher, meaning investors would be willing to pay more higher for $1 of sales when this happens. All right. Now, this is how to calculate the calculating relative multiples there. Forward P ratio is payout ratio minus over K minus G, payout ratio 50%. And then the required return, that's 12%, the cost of equity. Required return is because we use the CAPM model, right? CAPM required return. We use CAPM required return to calculate this. And then minus growth rate is 8%, that's 12.5%. Trailing is in the 13.5%. And trailing up the price to book ratio is, return on equity Where is the return on equity? Is 19.5%. And then the payout ratio 50%. Divided by 12% minus 8%, 2.475. For sales, price sales ratio is profit margin, where is profit 23.5% times payout ratio divided by the cost of equity minus growth rate, 2.938%. So this is how you calculate this, relative multiples. Okay. Now let's look at how to calculate and how to use that in this relative valuation method. There, it's simple. We have Cisco, and this one is smaller company, but competitor. Okay, competitor. So we got the market capitalization, is 171 billion, debt 35 billion, and expected growth rates 4.6, and expected return on equity 21%, expect profit margin 25, and expect payout ratio 78, cost of equity 8.9%. Now, given this expected value, right? The first step, I told you, calculate expected the fundamental, like intrinsic fundamental, like theoretical value. Okay, how do you do that? Ford P ratio is what? Ford P ratio, here, payout ratio divided by K minus G. So payout ratio is, where is it? Payout ratio is 78% divided by K minus G. K is cost of equity, 8.9% minus growth rate is 4%, 4.6%. That is how you calculate this, for the theoretical fundamental, like the P ratio, P multiple. That's 18.14. And then the trailing PB, the same way, right? So the same way for PS, I told you here, okay, using that one, you calculate this one. I already calculate that way. And then the next step is, this is, as I said, like, expected, is like theoretical value, fundamental value of this relative multiples. And then the next step, after calculating this one, you compare this one to actual value using actual price, right? Actual value, then you get this one. Okay. Now, look at this. All this one here, all this one, the ratio, the P, the stock price, that is in the numerator, right? Numerator. So if the price here, let's compare these two. Actual price, the actual, like, Ford P ratio means you use actual price level, right? It is lower compared to the fundamental. Lower means the price is, look, current market price is lower, underpriced there. You see what I mean? This one seems to be underpriced. And this one same thing, and this one same thing. See, P is current market price, appears that the current market price is undervalued. So comparing this fundamental and actual value, our conclusion is this Cisco stock price is undervalued. What does that mean? Undervalued means this one is good investment. It's a pretty good good investment. All right. The exactly same way for Jupiter, its competitor, it shows this way. Based on the P ratio, they are very close, but slightly overvalued or fair valued. This one is undervalued, and this is like, slightly undervalued. So overall, kind of, undervalued side. So this one is definitely undervalued, and this one is slightly undervalued. So these are good investment. this is a good investment. In other words, it's a good buy. Good buy. Actually, it's time to goodbye. Say goodbye. You have any question? Let me stop this recording. How do you stop this?